You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and man, is there so much stuff going on right now. I get asked every day by clients, by people in the community, when I'm out and about, how is the election going to affect the stock market and the economy? We've also got big news coming out this month about interest rates and inflation, especially inflation. And then the real key is, how is the Fed likely to handle this information with the promising numbers that we're seeing with inflation from the month of June. And then we've had a new rule that has finally been passed by the IRS regarding how you must take distributions from retirement accounts that you inherit from someone other than a spouse. And we're going to get into all of that stuff today. I'm also going to, at the end of the show, I'm going to touch on Social Security election as it relates to your tax planning, because this is a very overlooked area of Social Security election. Everybody talks about what's the best time to draw to maximize your benefit, but what about the tax planning opportunities that you might face? And how your Social Security strategy could affect that. So we got a lot of good stuff to talk about. Let's dive in on the election. Obviously there's a lot going on. In the last week, we've seen an assassination attempt of the former president, Donald Trump, more and more growing calls for Biden to step aside. It appears the latest news is he's digging his heels in and refusing to step aside. We don't know how that's going to play out. The bottom line, though, is, because this is not a political discussion, this is an economic and a stock market conversation. It is a high-stakes battle. The 2024 presidential election is set up to be a very significant political showdown, and it does have implications on the economy. Economic growth, inflation, job stability, these are all key issues influencing the election, and both candidates have different approaches to handling these economic challenges. So we'll get into that just a touch. What about the impact on the dollar? Political uncertainty in the outcome of the election could absolutely lead to fluctuation in currency markets. Stock market reactions, equities are likely to be impacted in the short term with potential volatility as investors react to the political landscape. And, the policies that are proposed by each candidate will certainly play a crucial role in shaping market sentiment. And then investor sentiment. How will investors, what are their concerns about what a future administration will look like and how it manages economic policies? So how do you get your arms around all this? Because, as I said, it is really kind of one of the top questions, maybe the top questions that I'm getting. And it is a very, very high-stakes election. I think everybody agrees to that. And regardless of who the Democratic candidate ends up being, it's a big, big showdown. Here's the thing. Markets are going to react based on what investor sentiment feels about the different policies of the two parties. Which one's more likely to be in office? How might that affect economic policy? Now, it does seem on the surface, many often say, well, the Republican Party is more for less regulation, um, lower tax rates. That should be good for the stock market. And that does make sense on the surface. But then you've also got a Republican Party that is a little bit more isolationist now, more tariffs on imports. There's just so many things that can affect the economic landscape. Likewise, Democrats, are typically they want the Tax Cuts and Jobs Act to expire at the end of the next year. That would be a tax increase. There has been more regulation. How do each of the parties attack inflation? The Republicans would be likely to open up drilling in the United States and could drive down the cost of oil, which could lead to a decrease in inflation. So how do you react to all this? My overriding message is this: don't allow politics to affect your investment and financial planning. Now, why do I say that? Because we have done research back to George Washington and looked at election cycles, market dynamics, economic dynamics, especially since World War II, if you want to go more of the modern era and the modern stock market era since World War II. The reality is there are not really strong correlations that say one party rule is better than another. If there's any one thing that we could point to, it's that the market does tend to like a divided government. Okay? But that's not going to stop investor sentiment from driving markets based on short-term speculation. So I think as we get closer to the election, we are likely to see more choppiness and more volatility if there is more uncertainty about the election. And then coming out of the election, if there's uncertainty, will we know the day after the election, will we know who won? And if we don't, that would lead to more market uncertainty. In the end, what really drives the markets and the economy under different presidential terms? And the reality is, when you look back on it, it's really the underlying economic conditions at the time. Think about it. When Barack Obama took office in January of 2009, we were coming out of the Great Recession. The stock market in March of 2009 was down a whopping 55% from its previous highs in the fall of 2007. We were likely going to have a booming stock market over the coming 3 or 4 years. That's just a reality of coming out of the Great Recession. You look at when Donald Trump came in January of 2017. We had a huge spike in the stock market. Well, we also had very, very accommodative Federal Reserve policy. They were printing money hand over fist, flushing money into the economy. Many could argue that the underlying economic conditions of economic stimulus from Federal Reserve had a lot to do with the boom that we saw. We had the pandemic in 2020, of course. Now, then Biden comes in January of 2021, and we're dealing with coming out of that pandemic, and we've seen economic uncertainty. The markets have been and proven to be resilient even in the face of inflation. So we just, and they're actually, and I've talked about it on this show before, there has been research that has shown that the political beliefs of an investor tend to work against them if they allow those beliefs to shade their investing. So, for example, if a Republican is in the White House, Democrats tend to be more fearful of the stock market moving forward. If a Democrat is in the White House, Republicans tend to be more fearful of markets and what the stock market may do. So we have to be very, very cautious that we do not allow our politics to affect our investment and financial planning. We know that in the short term, the stock market has the potential to be extremely volatile. and we know it is very, very unpredictable. As a matter of fact, when we were going into the 2016 presidential election, the consensus among economists was that if Donald Trump was elected, we would probably see a stock market correction, meaning more than a 10% downturn in the stock market. The economists felt like the stock market would like a Hillary Clinton victory more. And why is that? Because Donald Trump was such a wild card. And the markets, the economists felt like the predictability of what they're getting with Hillary Clinton would be stronger for the stock market. So that was what the prediction was. Yet, coming out of the election, we had an immediate surge in the stock market. And that surge was based on speculation of what was likely to be economic policy under Donald Trump. The reality is, in my view, what really led to the boom in the stock market and the economy from 2017 through up until the pandemic was a combination of economic policy out of Washington, but also this incredible economic stimulus from the Federal Reserve. So the market is going to react, and it's going to have short-term volatility. Whether that lasts is yet to be seen. What policies are actually implemented, and how does the economy react to those policies? But we got a lot on the table right now in terms of the economic impact. We've got the inflation, we've got Federal Reserve policy, we've got our view of world trade on the line here. So there's just a lot of things that are at play. We know that because the stock market is incredibly volatile and unpredictable, that when we invest and take risk in the stock market, it should be with a longer term view. We should never be investing in the stock market based on what we want our money to be worth 3 months from now, or even a year or 2 years from now, because it's completely unpredictable. To be successful investing and taking risk, you've got to, number one, have a more long-term view. The longer term your view, the more certainty I believe that you'll have with your investment plan. And taking risk, taking a calculated amount of risk, and having a diversified portfolio that takes a calculated level of risk has proven historically to be the best way to fight inflation. And with people living longer and longer lives, you retire today at 65 years old, you've got to plan on a 25 to 30 year likelihood of needing your retirement savings to last and provide income. And inflation, therefore, over the long haul becomes as powerful opponent as you'll face. So market investments are invested for at least 5, 6, 7 years from now. So be very, very careful not to let your politics affect your investment plan or your financial plan. Nobody knows what the future holds. I know everybody is, concerned about where we are, whether you're on the left or the right. Everyone is concerned about the current state of politics and things in the United States. Bottom line is, we don't know if something bad may happen. We just have, historically, if we look at history as our guide and our teacher, markets just, we have to be very cautious of allowing politics to affect our investment and financial planning. We're going to get to our first break. When we come back, I am going to dive a little bit more into the new inflation data from June and what that says about interest rates and Federal Reserve policy, which in my view is as important as an economic issue as we face the last half of 2024. So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. We're talking about the U.S. economy, how the presidential election may affect it. That was what I talked about in the first segment. In this segment, I want to talk about the new inflation data and what it may mean for us. It's actually extremely good news, but I do think we have to be careful. There was an unexpected decline in consumer prices in June. The consumer prices fell by 0.1%. I know that's small, but it did not go up, and it has surprised economists who had anticipated a slight increase rather than a slight decrease. And it really marked the first really significant departure to the in terms of inflation, signs of it coming down than we've seen in several months. The annual inflation rate slowed to 3%, which was significantly lower than previous months, and that indicates a substantial reduction in year-over-year price increases. It highlights the success of recent measures to curb inflation. Now, by the way, I do want to mention, I know that it does not seem like inflation is down at 3%. And that's because of the cumulative effect of inflation. You know, we're compounding 3% on top of what just short time ago was 8.5% inflation. And so, you know, it's not like prices are coming down at the grocery store. And as a matter of fact, in June, food prices actually went up. The most notable things that seem to impact consumer prices is used cars and energy prices came down. The unexpected drop does raise hopes that the Federal Reserve may pivot towards cutting interest rates, which would mark a potential shift in monetary policy aimed at economic stimulus. So the idea is, you know, the Fed would start to lower interest rates again to stimulate economic growth. And to make sure that we don't enter into a recession with these higher interest rates. Now, this news has led to increased market speculation that the Fed will reduce interest rates sooner than anticipated. So, you know, a couple of months ago, the thought was the Fed might do one rate decrease late this year, maybe in December. Now the thinking is that we might see a rate decrease in September and then another one in December. I think we need to be very, very cautious here. You know, despite the short-term decline, inflationary pressures could resurface depending on future economic conditions and policy decisions. And in my view, I think there needs to be a cautious approach to long-term projections. There will need to be sustained efforts to ensure long-term price stability. So the Federal Reserve's in a little bit of a tricky spot here. Jerome Powell has maintained consistently that he will not rush to cut interest rates, but he has also signaled after the June inflation data came out and was promising, he did signal a little bit more receptivity to doing an interest rate cut sooner than later. I think this is maybe, and I've been saying this for several months, possibly the number one issue facing our economy. The economy is still pretty good. It has shown some signs of slowing down. We are not seeing signs of a coming recession. Unemployment is still under 4%. And, you know, the Fed has a dual mandate. Stable prices, which is inflation, and full employment. I have a hard time seeing the Federal Reserve lowering interest rates when unemployment is under 4%. So I think the Fed has to be very, very cautious. I do think rate decreases are coming. It's just a matter of, will it be late this year? Will it be in September? Will it be next year? I think that we're likely to have one cut this year, and we might get two. So if I was in Las Vegas and I put an over/under on it, I would put it at 1.5. As I think where the odds makers would put that. So how should you as an investor react to this news and this balancing act from the Federal Reserve. I think the most important thing is don't try to time it in the short term. Also, be careful how you use bond investment in your portfolio. You know, the traditional approach to diversification has been to do a balance of equities, the stock market, and bonds. And I can't tell you how much I still see people come into my office and they've got that classic 60-40 mix of stock and bond funds, or 70-30. And the idea is, historically, the bond exposure, bonds in the short term are not as volatile as stocks, and they typically have been negatively correlated to stocks. So in other words, if stocks are down, bonds are up. If bonds are down, stocks are up. But the last 5 years, those correlations haven't held true as much. In 2022, both the stock market and the bond market were down double digits. It was the worst 60-40, this is the worst performance of a classic 60-40 portfolio since World War II. And bond investment, having too much in traditional U.S. bonds and bond funds, in my view, is a tremendous risk over the longer haul. So, I said earlier that, the stock market's completely unpredictable in the short term, and bonds provide a little bit more stability in the short term. But in the long term, bonds have tremendous inflationary risks. Now, that doesn't mean you shouldn't own any bond exposure. That is not what I'm saying. But I'm saying having 30 or 40% of your portfolio in traditional bond investment in the United States, I think could be a real challenge and a mistake. And I've been saying it for several years. And it has borne true the last 5 years. So we have to be very, very careful there. So you need some traditional bond investment. But then I think, number one, you need some non-traditional bond investment. Now, what is that? Traditional bonds by, traditional bond mutual funds, which is what most people own for their 30 or 40% bond mix, is buying bonds in U.S. companies, maybe treasuries. If you have a bond with Coca-Cola that matures in 5-6 years, you're buying a fixed bond, and you know exactly what you're going to earn, and then in 5 or 6 years it's going to mature. Well, there are some bonds that have adjustable rates, and it's kind of like the difference in a fixed mortgage versus an adjustable rate mortgage. If a bank makes a loan to a big U.S. corporation, that loan is usually tied to something like prime, and it adjusts quarterly or even monthly. So, in other words, the rates go up with, if rates go up, then the corporations have to pay a higher rate. You can also invest in foreign bonds. Foreign bonds is a way to hedge the U.S. dollar. When we talk about diversification, what we really mean is we want a lot of stuff in the portfolio that if one thing zigs, another zags. That way, if one thing like stocks is way down, hopefully they're not all way down. Bonds in the last 5 years have proven, traditional bonds have proven to not be as effective as a hedge against underlying market downturn. And that's really kind of what you're talking about. When you try to add more stability to your portfolio, you're talking about wanting to add more diversification, more things that zig and zag. And that way, hopefully, you don't lose as much when markets are down. Now, that also means you're more than likely not going to make as much when markets are booming. So you have to find that right balance. But my takeaway on the interest rate environment and Federal Reserve policy, number one, I think the Fed has to be very, very cautious not to have a new round of inflation. But then number two, be very, very careful how you use bond investment in your portfolio. Be sure to be more diversified within the bond category. And I'm just not a fan of having 40 or 50% of your mix in bonds and bond funds. I think you need to have more diversification than that. Now, when we come back, the IRS has finalized a rule for heirs that inherit retirement accounts. IRAs and 401ks, 403bs, all those things. There have been two changes to the retirement account laws, the Secure Act and the Secure Act 2.0 in the last 5 years. And we finally have I'll call it a new rule, but it's a finalized rule from IRS about inherited retirement accounts. So stay with us. We'll have that in the next segment. And I'll also talk about why I think IRA planning, handling your IRAs at death, is the most overlooked area in estate planning today. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thank you for tuning in this weekend to More Living with Jim Brogan, where it's all about living the best years of your life your way. Now, we're with you every Saturday, 9 to 10 a.m., and again, 3 to 4 p.m. right here on News Talk 98.7 WOKI. You can also catch our podcasts of our shows. You can either go to broganfinancial.com and listen directly if you click on radio, or you can go to Spotify or Apple Podcast. We'd love for you to tune in. My upcoming class schedule, I'm starting back in August. I have an income planning class, August the 20th. At Pellissippi State, and then more classes to come in the fall. You can find our full list of upcoming classes through both the University of Tennessee and Pellissippi State, Hardin Valley, at my website, broganfinancial.com, and click on resources and classes. The IRS has finalized a new rule for heirs that are to inherit IRAs, 401ks, and other retirement accounts. Now, this is just horribly confusing. So, the rules change going into 2020 on how you can inherit a retirement account. Think about your IRAs, your 401ks, your 403bs. The money's in those accounts. Most, if not all of that money, has never been taxed for income tax. So I'm talking about all retirement accounts other than a Roth, right? Well, somebody's going to have to pay that income tax. And I've talked about it on this show many, many, many times over the years. When you inherit a retirement account, you could potentially be inheriting a tax time bomb because all those income taxes on that account have to be paid by somebody. But the question is, how quickly do they have to be paid? And under the old rules prior to 2020, the beneficiary, now I'm talking about anyone other than a spouse, because a spouse has the ability to continue an IRA in their own name. It's called a spousal continuation. So if I die, my wife can take my IRA and just continue it in her name, or think of it as almost like a spousal rollover. And once she does that, it's her IRA, not mine. But anyone that other than a spouse cannot do that. And so the rules have been, starting the year after death, the beneficiary has to start taking out a distribution because then you get a 1099. The IRS wants you to pay tax on that. Or I guess I should say Congress wants you to pay tax, because Congress passes the rules that the IRS then has to enforce. Well, it used to be you could take those distributions based on your life expectancy. So if you're, and I don't have the table in front of me, but if you're 45 years old and you have a 44-year life expectancy, then the first year you'd have to take 1/44 of the account out. And then the next year you'd have to take 1/43 and then 1/42. So you'd have to take it out over your remaining lifetime. You can always take more, but you have to take a minimum every year. And we would call that a stretch IRA. You can stretch those distributions across your entire lifetime. And that was a very effective tax strategy for trying to continue the tax deferral in the retirement accounts and reduce the tax impact. Instead of paying taxes all at once, on a $500,000 IRA, you could stretch those distributions and pay taxes in much smaller amounts over a long period of time. And if you inherited a retirement account prior to 2020, you can still use that rule. But if somebody passed, if the date of death was on January 1st of 2020 or later, For the most part, beneficiaries are not able to do that, what we call stretch IRA. There are a couple of exceptions. I'm not going to go into the exceptions. The biggest one is if you have a beneficiary that's less than 10 years younger than you, like a brother, a sister, a sibling, can still do stretch IRA. But most everybody has to now take all the money out within 10 years. So Congress passed this rule where they want when you inherit their retirement account, they want you to empty it within 10 years because they want you to pay the tax. And we know what our budget situation, we know what our deficit spending looks like, we know what our federal debt looks like. So Congress decided they want to start tapping the money in the retirement accounts and get it out more quickly when somebody dies. Likewise, if you have a Roth IRA, the rules are the same for a Roth. They're just tax-free over the 10 years. But the IRS doesn't want you to be tax-free for the rest of your lifetime and stretch those distributions across your entire life. So now, if you do things correctly and you name beneficiaries appropriately and you do all these things, you have to empty, when you inherit a retirement account, anyone other than a spouse has to empty that within 10 years. Like I say, there are a few exceptions that I'm not going to get into all the exceptions today. But your kids, your grandkids, for the most part, have to take it within 10 years. Well, what had been confusing is in the new law that was passed with the Secure Act by Congress that went into effect for early 2020, well, what happens during the 10 years? Like, what do you do years 1 through 9? Under the old rule, you had to start taking distributions the year after death and be taxed on those distributions. Well, the new law, it said you just have to take it over 10 years. So what do you have to do in year 1, and year 2, and year 3? So the IRS proposed a rule that you would have to, this is where it gets confusing, if the owner of the retirement account died after they started taking their required minimum distributions at 73 years old, if they died after that, then you would need to start taking a minimum distribution in year 1. And you would have to do that every year over the 10 years. Now then, whatever's in that account in year 10 would have to come out. But there was a lot of confusion about whether or not that was really what Congress intended. So the IRS finally has finalized this rule that says if you inherit a retirement account and the date of death was after January the 1st of 2020, and if they were past they're having to take required minimum distributions, you would then have to start taking a distribution in year 1. Now, it won't go into effect until next year in 2025, so if you haven't been doing that, don't worry about it. The IRS has passed relief and said, all in 21, 22, 2023, and 2024, they're not going to make people take money out. But this is just more and more confusion in the rules. If somebody dies before their required beginning date of having to take money out of their retirement account, then the beneficiary does not have to take any distribution in years 1 through 9. And if you inherit a Roth, there never is a required beginning date on a Roth. You don't have to take RMDs from your own Roth. So when someone inherits a Roth, if I inherit a Roth from my dad or my mom, then I don't have to take anything out until year 10. So what this means is tax planning for retirement accounts, estate planning, becomes even more critically important in having your kids understand what the rules are and how they can deal with the tax implications of what is essentially a tax time bomb. Or if they're inheriting a Roth, how can they maximize the tax-free nature of that Roth? Becomes even more critically important. And then to kind of piggyback on that, we also have to be aware that when we name a beneficiary, on a retirement account. When you open up a retirement account, you're asked on the account application, whether it's an IRA or 401k or other company plan, you're asked on the account application to name a beneficiary. And we typically don't think twice about it. We just list, probably a spouse, then kids. But that beneficiary designation has total control and authority over who gets what. In other words, not the will. The beneficiary designation supersedes the will. So this is, in my view, the most overlooked area in estate planning today. Most estate planning attorneys that I talk to would agree with me on that. I'm not an attorney, but most would agree with me on that. And so the tax planning nature of leaving retirement accounts to your kids, along with the beneficiary planning that has to be coordinated with your legal documents, is so critically important and has only become more important with all of these new rules from the IRS. And it's just confusing, but that's the tax code, right? I mean, when the Income Tax Act was passed in 1914, the initial tax return was one page, and the tax rate was a marginal system like what we have now that went from 1% to 7%. And now we have a tax code that I like to call the Full Employment Act for CPAs and attorneys, because it really takes almost a PhD to understand the code. So, this just makes it even more complicated with these IRA rules. So be sure that your beneficiary designations and your tax planning for your kids, or at least having your kids understand the implications of inheriting retirement accounts and having a plan to make sure that they either get that information and education now while you're alive, or that they get that education and information upon your death. Cannot tell you how important that is. Now, when we come back, I'm going to talk about Social Security election and how it can affect your tax planning, because this is very, very overlooked when it comes to Social Security election. Everybody focuses on how can I get the most out of Social Security, but what about tax planning? That can have, for many of our clients, a big impact on their Social Security strategy. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. This is More Living here on News Talk 98.7 WOKI. We've been talking about the economy, inflation, Federal Reserve, the upcoming election, its impact on your investments, what should you do about it. Also kind of some confusion from the IRS, not surprising. In this segment, I want to talk about your Social Security election from a tax planning perspective. Income planning for retirement is so important. It's how much can you draw from your investments and safely and be confident you're not going to run out of money? How do you structure your investments to support that income? How do you grow your income over time for inflation? What do you do with Social Security? Now, as we know, we get a nice increase in our Social Security benefit if we delay to age 70. That doesn't mean everybody should delay. But regardless, full retirement age is somewhere between 66 and 67, depending on when you were born. Bottom line, the difference in benefit, if you look at your age 62 benefit, and then you look at what it would be at age 70, it's over a 75% increase. And people are living longer and longer lives, so we have to be very careful about how we consider all that Social Security election. And spousal benefits, widow benefits, all that stuff affects that. But what about tax planning? Most people have more control of their taxation in retirement than at any other time of their lives. Because especially in what I call the sweet spot of retirement, those years between retirement age and age 73. Why age 73? Because that's the year you have to start taking taxable distributions from your IRAs and 401ks. But prior to that, where are you going to draw your income from? You know, if you go down to the bank and pull out $100, that is not a taxable event. If you sell a stock or a mutual fund, part of that stock or fund you've already paid tax on, so it's not taxable. And then the rest of it is, if you've owned it more than a year, is a long-term capital gain, which is a preferential tax rate than ordinary income. If you take $100 out of your IRA, it's fully taxable. Well, if you have some control over that, right? And how it affects your income taxes. You know, unless all of your money's in retirement accounts, you have some control over that. Well, Social Security income is also, you have control over that too. And if you delay Social Security, you're keeping numbers off of the tax return. Now, Social Security is means tested from a tax perspective because some people pay no income tax on their Social Security income. Many pay tax on 85% of their Social Security income. Now, no matter how, and it's means tested, the more you make, the more tax more of your Social Security is taxed as ordinary income. But no matter how much you make, 15%, 15% of it is free from income tax. But those are numbers that show up on your tax return, and that means you're starting to fill up those lower tax brackets with taxable income. And that, you know, the lower your income, the more you can be effective with doing things like Roth conversion planning, capital gains tax, which I've talked a lot on this show about, you know, long-term capital gains, income for a married couple 65 years old up to about $125,000. Any portion of that that's long-term capital gain has a 0% tax rate. And that's one of the most overlooked tax opportunities out there. And then Roth conversions, being able to convert at 10, 12%. So, I mean, I have high net worth clients that if they wanted to could be in a 0% tax bracket in the sweet spot between retirement age and age 73. But that doesn't mean they should be in a 0% bracket, because then what happens at 73 when they have to take taxable distributions from their retirement account? So we want to look at things like Roth conversion, capital gains taxes, and all of those opportunities. If you are delaying your Social Security benefit, that is keeping those numbers off of your tax return so that you can do more tax planning. Now, should that one thing be driving your Social Security decision? Well, absolutely not, right? But it should be a factor, and it should be considered, especially if you have large retirement account balances. Now, my next class through Pellissippi State Hardin Valley is Income Planning for Retirement. And it is on Tuesday, August the 24th. It is a one-night class, and it's from 6:30 to 8:30 p.m. at Hardin Valley, free parking, very convenient to West Knoxville. And if you're transitioning from savings to an accumulation phase of life, that's what you're doing when you retire. You're moving from this savings phase into this spending phase, and it puts a unique set of pressures and stresses that can threaten your nest egg. How do you create reliable income in retirement to ensure you aren't withdrawing funds when markets are choppy or down? How do you reduce taxes on your retirement income? We talk Social Security, like we talk about all these things. To get more information, you can go to PellissippiRetirementIncome.com. PellissippiRetirementIncome.com. You can get more information. You can click to register. Again, it's on Tuesday, August the 20th. It's just a one-night, 2-hour class. PellissippiRetirementIncome.com. I'd love to see you there. Thank you for tuning in this week. We've discussed your wealth, because greater wealth provides for more living, so you can live the best years of your life your way. Thank you to Wayne for engineering the show. Thank you to Jill for helping produce the show. Have a very blessed weekend. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.